All right, welcome back everyone to this 7th video. In this series, we are building out a company, following it through a series of transactions, and seeing how to record those transactions so we can see how the basic accounting equation works in real time. If you haven't seen the previous videos, make sure you go watch that, because in the very first video, I show you where to download the workbook for this course, and you're gonna need this workbook in order to follow along with this series and follow along with this build out and to get the most out of this course. All right, in this video specifically, we're gonna take a look at how you record a sale. Up until this point, we've done everything to get this company ready. We've invested money in this company. We've raised additional capital. We've purchased equipment. We've purchased inventory. And now we're finally ready to make our very first sale. So let's get into this video. All right, I'm looking at my computer screen. I'm on journal entry number 7. And I'll go ahead and zoom in to the description here. Get this just right. All right, so now the date is December 1st, 2020. Sale 30,000 mugs at $2.50 per mug on terms of 210 net 30. All 30,000 items were shipped as of the same day with FOB shipping point to customer Coffee World. In this transaction specifically, we're just going to record the sale. Okay, let's talk about what's happening here. We're making our very first sale in this company. We're going to sell 30,000 mugs at a price per unit of $2.50 per mug to a customer named Coffee World. We are extending this customer terms. The terms we're giving them is 210 net 30. If you remember back to the previous video, when we purchased inventory from a vendor, we had the same term. So 210 net 30 means, hey, customer Coffee World, if you pay this invoice after we ship these items on 12/01. If you pay anytime from now through 10 days, we'll give you an additional 2% discount on this invoice. Otherwise, if you pay it any time after that, up until 30 days, you just need to pay the balance on the invoice. And we're basically saying, hey, you need to pay by the 30 days. And of course, if they don't pay by the 30 days, that's when the relationship can start getting soured, and it might change the way you do business in the future. So this is the transaction. And let's take a look at how we book this. Okay, so there's two things here. We're gonna record a sale, and we're not receiving cash on the sale right away. We're going to record what's called an accounts receivable. Basically, it's an asset that sits on your balance sheet, and it's basically saying, hey, there's a customer that owes us something. So it's not cash, but it's treated as an asset similar to cash, but not as liquid as cash, because we still have to collect on this account. So let's take a look now at how this transaction would actually look like. So first thing, we'll put in the post date, 12/01/2020. And the account we'll use, we'll record the accounts receivable piece first. Okay, so an accounts receivable is they call it a trade account. Anytime you sell something on terms, you're going to record that in your accounts receivable account, also called a trade account. Almost every company that sells inventory has this exact account named accounts receivable. This is pretty standard in most companies. So we'll use this exact account. And real quick, we can just look at the general ledger. We can see we have our accounts receivable right here, and we haven't booked anything to this account, so it's blank, and it's set as an asset account. And also, just real quick, we can look at the balance sheet, and we have a place right up here, accounts receivable net, nothing on the balance sheet yet. So we're going to go ahead and record this transaction now, which will change that. So we'll say, write a little memo here, 30K units sold to Coffee World, $2.50 per unit. It's kind of long. 30K units. I'll just stretch it a little bit. Okay, there we go. And it's an asset. So when an asset increases, we should know by now that that is going to be a debit. So I will go ahead and just put a formula base in here. I'll put 30,000 units times $2.50 per unit. That's going to be a sale of $75,000. Now we need to record revenue. Okay, this might not be super intuitive if you're brand new to this. Okay, so let's go to our cheat sheet real quick and let's take a look at this. We're dealing with revenue now. So when we're dealing with revenue and revenue increases, it's going to be a credit. That might not sound intuitive, but this is how accounting works. And instead of going in a ton of detail on why this is the reason or why it's set up like this, the thing I really want you to rely on now is just understand that this is a system like any other language. And if you follow this very basic guideline, you probably won't go wrong. So here we go. We're dealing with revenue. The revenue is increasing. We had no revenue, and now we have $75,000 of revenue. So in this particular case, when we're dealing with revenue like this, that increases, that's going to be a credit for us. So we're going to go ahead and finish this journal entry now because we're out of balance. And I'll put in the same post date, and the account I will select is sales. Okay, so I have sales. I set up sales. We can just take a look at the general ledger the way I have this set up. We have our assets, our liabilities, our equity, our revenue accounts. Really, it's just sales and returns. We're dealing with sales, so it's going to be sales. And then I have a bunch of expense accounts. So let's go back. We're going to use the sales account. And I'll put in the same description, and it's going to be $75,000. Now we're only recording the sales piece in this specific transaction. There's essentially two components that happen. One is to record the sale. Two is to record the releasing of that inventory and the recording of the expense related to that inventory. We're going to do that in the very next video. But for now, we're just going to record the sale. So let's take a look at the general ledger right now. And let's see. So we have our accounts receivable. So now we have a balance in our general ledger account, our accounts receivable for $75,000. If we look in our general ledger sales account, we have a credit balance of $75,000. And we haven't done this in a while. Remember that your trial balance, which is this report of all your general ledger accounts or your chart of accounts, the list of all your accounts in your general ledger, they will always net to zero. And we can just test that here to see that we're doing everything correctly. And it sums to zero. And this shows you it sums to zero. This is my formula right here. So everything's looking good. We'll jump to the income statement now. And now you can see we've pulled in, this statement has pulled in the revenue piece. Now you would never be able to give this financial statement to anyone because it's not a completed statement at this point. We haven't recorded the cost of goods sold, which is the cost that the inventory personally costed our company that we sold for a profit, right? So it's not complete yet, but we can at least see how this financial statement is starting to come together. Let's take a look at our balance sheet now. And you can see that the total assets in the previous video was $150,000. It's now jumped up an additional $75,000 of assets related to our accounts receivable. We made a sale, and that sale is showing that, hey, we have an asset on the books. We haven't collected the cash yet, but we have an asset that says we are legally entitled to $75,000 from this specific customer. And if we go down here to our liabilities and shareholders equity account, we'll see now that the total liability and shareholders equity also equals $225,000. Well, how did that happen? Well, one component of shareholders equity is your retained earnings section. That pulls in the balance from your net income. Now, this might get kind of complicated and this might take a while to digest. But basically, what we're saying is that our equity of our business has increased by $75,000 because we've made a sale. So we have additional equity, our retained earnings. We have retained earnings. This is also retained earnings, but this is just split out. This is retained. The way I've split it out is this is retained earnings that would be related to prior years, and then this would be your current year retained earnings. But essentially, both of these together would make up your retained earnings. So our retained earnings in this company is $75,000. So you can see now that our total assets equals our total liabilities and shareholders' equity, and thus satisfying the basic accounting equation. And this might be super confusing to some people. I know I personally struggled for this when I was in college, and even when I first got my first professional job as an accounting. For some reason, I struggled with this concept, but the more you do it, the more you'll understand. And my whole goal for you is that this workbook would help you understand this concept a lot more quickly, so that you can get ahead in your school or wherever you're at in your professional career. So that's the transaction. Now, the only component we need to still do is we need to record the receivable in our balance sheet account, our reconciliation sheet. So let's go now to our Accounts Receivable tab, and I'll go ahead and zoom in, and just to make sure I got the right customer, Coffee World. So I'll put in our Coffee World. I'll put invoice, just make this up. The date, this was on 12/1/2020. Memo, sold 30K units. And the type, oh, we don't have anything there, so didn't fit in it. We'll just put this as an invoice. We'll type it in. Doesn't really matter. And the amount was for $75,000, and I'll put that in as a debit. And you can see that I actually have the general ledger linked up to this cell, and so our schedule now agrees to our general ledger, which agrees to our balance sheet financial statement. So that's the video. I hope you're getting excited about this. This is the stuff that I really get excited about, and you can see how we are now progressing, and now we have a company that has really come along. We've put capital in it. We've made significant capital purchases, and now we've made our very first sale. And now we're starting to see how the financials are starting to come together and how everything should be kind of making sense. And that's it. If it was super confusing, maybe try watch it again, but hang in there. We're not done yet. We got more videos to come. So I look forward to seeing you in the very next video. All right.